Portfolio Construction and Risk Management. Chapter 13. Stress Testing and Scenario Analysis. Section 5. Portfolio Resilience. Portfolio resilience is really about survival under pressure. A resilient portfolio can take a hard hit, cover its needs, and avoid forced decisions that turn a temporary setback into permanent damage. In calm markets, that may not look especially dramatic, but in real stress, it matters enormously. Low volatility and resilience are not the same thing. A portfolio can look smooth and stable for years while hiding concentration, illiquidity, or leverage that only shows up when markets break. And the opposite can also be true. A portfolio that experiences normal short-term swings may still be built to hold together when stress arrives. 3 features tend to drive resilience again and again. First, real diversification across different risk drivers. Second, enough liquidity to meet cash needs. And third, financing that is stable enough that a drawdown does not become a forced sale. When those 3 work together, a portfolio is much more likely to stay functional in a crisis. Diversification only helps if it is diversification in substance, not just in appearance. Owning many funds or asset labels can still leave you exposed to the same underlying economic shock, especially when correlations change in a crisis. That is why resilient portfolios are built around distinct risk factors, not just a longer list of holdings. Liquidity is what keeps a portfolio usable when conditions get difficult. Cash and near-cash reserves let you cover spending, taxes, redemptions, or collateral calls without selling long-term assets at depressed prices. Even a fundamentally strong portfolio can fail the resilience test if it runs out of ready cash at the wrong moment. Leverage makes this much more fragile. Borrowing can boost returns on the way up, but it also shrinks the margin for error, so losses compound faster and margin pressure can arrive before markets recover. That means the portfolio may not get the time it needs to heal. Resilience is not just about how far a portfolio falls, but also how long it takes to come back. 2 portfolios can suffer the same drawdown, yet the one that recovers faster is usually more durable because it reduces the chances of panic, withdrawals, or other decisions that lock in losses. Time to recovery is part of the risk. Stress testing makes all of this more concrete. You map the portfolio's exposure to growth, inflation, rates, credit, and liquidity, define a shock, estimate the drawdown and recovery path, and then check for weak points like funding gaps or forced sale risk. The goal is not perfect prediction. It is to reveal where the portfolio is sturdy and where it is brittle. A simple example shows how financing structure changes the outcome. An unlevered mix of equities, bonds, and cash might lose about 25.5% in a 2008-style shock, while the same basic exposure at 1.5 times leverage could lose about 38.25%. The deeper loss matters, but so does the higher chance of margin pressure before any recovery can happen. So the core takeaway is straightforward. Resilience means a portfolio can take a hit, meet its obligations, stay invested, and recover. Smooth returns alone do not guarantee safety, and neither do old correlation assumptions if liquidity dries up or withdrawals keep coming. The strongest portfolios pair real diversification with cash reserves and careful control of leverage.